you look at this market, Victoria, there's very few places to hide. You really see the brunt of that bid in the bond market, but gold is down, Bitcoin is down, stocks across every major indexes are down for the most part. How do you position in this environment right now?
Well, what we're hoping is that a lot of people have done what we did with our clients over the past couple of months when we were seeing some of the warning signs that we thought we would see a larger pullback in this market, and start doing that rotation out of the momentum trade, start trimming some of those tech names that you had such high positions in, getting some cash on the sidelines and finding those areas in the market that we thought would do better in a downturn. So we were looking at some of the staples names, some of the healthcare names, utility names. You know, we liked financials, but we said wait for a pullback because financials had such a strong run. And we're starting to see those trades now start to do better on a relative basis. So do you go in today? I'm not sure. I think you take a little bit of a break today with what we're seeing in the market. Let things settle out a little bit and then start looking at some of those names that we mentioned, some of those more defensive, more staple plays in your portfolio, and building those up while trimming some of your other ones.
And Victoria, I do want to talk about what's going on right now, what's going on today, because it feels like we're still in diagnostics mode as to what is actually causing this massive sell-off that we're seeing right now. Of course, there's been a lot of talk about the carry trade unwinding, particularly those yen-funded carry trades. Just walk us through sort of, again, the chain of events there. What is actually fueling this sell-off and where did it start?
There's definitely, I think, a culmination of events that came together at the end of last week. The market is not reacting this way because the non-farm payrolls came in 60,000 less than expected, right? But I think that was kind of the straw that broke the camel's back in the sense that we look at earnings. I know earnings are up 11% year over year, but if you look across the board, you're not getting as strong of a guidance as people were hoping to see. So guidance is concerning regarding consumers. You were seeing yields already start to come down, not because inflation expectations were coming down, but because there were growth concerns coming down. You saw a lot of weakness in manufacturing and a lot of weakness in the labor market besides the payrolls number. You look at job openings, those were stagnating. You looked at quits, those were falling down. One of the most important recession indicators is really looking at the job differentials, job plentiful minus jobs hard to get. It hit a cycle low. So there were a lot of elements churning under the surface that were telling us growth is going to be coming back. Jobs are not there. Wages are not there. And that means trouble for the consumer. I think Friday, again, was a culmination of all of that. Add in the unwind of the carry trade that you were seeing as the Bank of Japan raised rates and the expectation that we would be lowering rates in September after the Fed meeting. All of that coming together, I think the market came to realize, wait a minute, things maybe aren't as good as we thought. Maybe that soft landing is not a given, and that's why we're seeing the reactions we are. We also have geopolitical events going on that adds to the uncertainty.